I'm out research market insights video for June 29th, 2023. Hey everybody, Willie Dowitch here. Glad you have tuned in for our weekly 3 for Thursday market insights video series. Today we're going to kind of take a little bit of a retrospective on the first half, but really focus on the idea that here comes a second half. What are we thinking about as we make that turn from H1 to H2? Specifically from the perspective of the economy, from the perspective of rates, and then finally from the perspective of the stock market. So GDP data out this morning. We'll dive into that, what it said about the first half, what that might say about the second half. This ongoing fight between the bond market and the Fed in terms of the direction of rates, where update on that, and then the stock market looking for some persistence, some consistency in terms of bull market behavior. So let's get into it. First chart here. This is GDP and GDI data updated as of today's GDP data report. And a couple key takeaways here. So last year, Q1 and Q2, we had back-to-back quarters of negative real GDP growth. We've never seen that outside of a recession. Now, Q4 of last year and Q1 of this year, we've had back-to-back negative quarters of real GDI, so it's gross domestic income growth. We've never seen that outside of a recession. Add it all up, we've had one quarter in the past 5 where both GDP, so production, and GDI income have been increasing. So if there's a feeling like we're in a recession, we've had recession-like behavior, even though we haven't had a call from the NBER in aggregate. Maybe it's is not fitting the definition of a recession just yet. So what does that mean for the second half? It means to avoid a recession, we need to see more consistent growth, both from an income perspective and from a production perspective. So far, what we've seen since the beginning of last year is an economy that is mired in slow and slowing growth. If we look at the trends overall, in order to have some confidence about the economy, we need to see that change in the second half of this year. Turning the page to rates. Here we're looking at the Fed funds rate. That's in orange. The Fed's been pretty persistent, continued to raise rates, talking about needing to have probably 2 more rate hikes in the second half of this year. It's been the bond market that has been pivoting. And really, that's been the story of the first half of this year is bond market catching up to the Fed in early March and saying, yeah, we can see the case for higher rates. After the banking crisis, saying, nope, the Fed's gone too far. We need to cut rates sooner rather than later. And now more recently, pivoting back towards this idea that the Fed is kind of right, that we need more rate hikes or are likely to get more rate hikes. You look at this from the perspective of Fed funds futures and the pricing there between what the market has priced in and what the Fed is signaling via its summary of economic projections, pretty much dead on. And those futures pricing numbers are as high as they have been since we were up above 5% in terms of the 2-year yield in early March. So what happens in the second half if the bond market continues to catch up to this view that the Fed is going to raise rates? Look for the long end to start to move higher, kind of reinforce that trend higher in terms of long-term yields, maybe steepen the curve or less invert the curve a little bit. And start to see the 10-year get back towards where it was in earlier this year and probably ultimately where it was at the end of last year, back above 4%. The long-term trend in the 10-year T-note yield is still higher, the most persistent rise in that trend since the 60s. But at the same time, the 1-year yield is the highest it's been relative to the 10-year yield since the early 80s. So there's catch up at the long end from a yield perspective. So look for yields to move higher if indeed we get consistent growth from the economy and if the Fed is right about needing to continue to fight inflation. So what does that mean for the stock market? Here, we like to look at things from the perspective of, one, we like to look at from a weight of the evidence perspective, but we also specifically from a trend perspective, this bull market checklist that we've been talking about. And 2 weeks ago, we finally got to 6 out of 6. You can see on the chart here, this shows kind of those scores over time. We got to that 6 out of 6 reading And then this week immediately dropped back down to 3 out of 6. And so I got a question, verifying that information. It got me thinking, how rare is it to have that sort of move up to 6 and then a big drop immediately after that? And it's been quite rare. In fact, you go back, showing data back to 2006 here. There's only been two other times where we've been at 6 and then dropped to 3 or lower. One time was early 2015, mid 2015, and then mid 2007. Both of those um, were at the end of strong periods. We had finally gotten up to to 6, and then dropped back, got back up to a higher reading, then ultimately rolled over. We haven't seen it kind of coming out of a period of weakness to get higher and then immediately turn back lower. I guess the takeaway there is this is a unique environment. There's a lot of indicators on the edge right now. Throw in higher yields and an uncertain economy, and some of the stock market trend data is maybe, I don't want to say less reliable, but more prone to reversal than it has been in the past. And so we've seen that globally, in terms of the percentage of world markets above their 50-day averages dropping from 70 back into the 40s recently. We've seen that from a new high, new low perspective, starting to see this week more new lows versus new highs, particularly on the NASDAQ. So the theme for the second half from the stock market perspective is, if the strength that we've seen in the first half was legitimate and can persist, then we would expect to see more persistent strength out of this bull market behavior indicator, not just a jump up to 6 and immediate reversal, but then to see it stay at three or higher as we go into year end. So those are the three for Thursday from the perspective of the economy, looking to see if we can get some consistent growth after we've seen consecutive quarters of negative income growth following last year's two consecutive negative quarters of production. Look at it from the perspective of rates to see if this rise in yields is going to be sustainable. Looks like it probably is. And then can the trend improvement that we've seen, both from a breadth perspective and from a price perspective in the stock market, persist, or is this another one of those head fake hires before we consolidate, or basically stay in this range that by and large we've been in since early last year? So thanks for tuning in. That's three for Thursday for the end of June. By the time we talk again, we will be into the second half of this year. So hope you have a great long weekend if you're doing something for the 4th of July, whether you're taking it, it's kind of in the middle of the week. So either this weekend or next weekend, or however you're dividing it up, get outside, enjoy the summer, enjoy the nice weather, and we'll talk to you again about the market sometime soon. Have a good day, everybody.